Good morning, students. We were discussing on the topic of issue management under your syllabus. This is your syllabus. Remember that we discussed, and basically we have now most of the parts have been completed under this issue management, equities, and debt security. But we have to do. Only thing, the first subject, I will upload today the answers and question, so you can be seeing them. And structuring of security is also a small thing, and other topics are not that much lengthy. But only thing, one subject we have to do is corporate finance, a little lengthy. So this is the lengthiest one: equity and debt management and issue management. So basically, we have completed the significant part of that. And so where we stopped last week. So any question you have at the moment for us to discuss? Do you have any questions so far? What we have done? We have discussed treasury bill, treasury bonds, and the option system, and also the advertisements published by Central Bank of Sri Lanka, and all those things we have discussed. Then we have moved to shares as well. So basically, I'll be taking an extra class next week, most probably tomorrow or day after, on Monday or Tuesday. I will let you know in the evening session, right? But if you have any work, you can later watch it. I will be doing the session tomorrow, day after. So then we have to little expedite the things as well. But don't worry about the syllabus coverage. So we have many subjects to cover it, many subject topics to cover it. But only thing, those are small things. Can go ahead, and I just want to have some discussion on past paper questions so far, what we have done, and how the examiner has tested so far the things we have already covered with you. So basically, I'll be taking some questions with you. Be ready with the question papers, and I'll be most probably taking the extra class with you tomorrow or day after. Right? I'll let you know, right? And remember that we discussed this part, and we have discussed some topics, the syllabus coverage on shares as well. And shares, in the sense, just to recap what we have done. Basically, there are two types of share market. One thing is primary market, one thing is secondary market. Now, only thing, remember that these markets are very much active in Sri Lanka, right? Very much active in Sri Lanka. So basically, IPO, initial public offerings. Initial public offerings, basically we discuss under primary market. Now, primary market, secondary market, we have discussed earlier as well when we discussed the government security, treasury bill and treasury bond. And here again it comes when we're discussing share market, the ordinary shares. Now, basically in the share market, you can see only ordinary shares are trading. Only ordinary shares are trading. So ordinary shares are trading, no preference shares are trading, right? So there are many types of shares. Ordinary shares are basically trading at secondary market in the share market, right? And what do you mean by ordinary share? Meaning you are the real owners of this particular company. If you have ordinary shares, you become a real owner of this particular company, right? So other shares you are holding, meaning that you are not the perfect, the absolute owner of this particular company. But if you are holding ordinary shares, meaning you are true owner. Ordinary shares also two types: voting and non-voting. So that also we discussed. Voting means only thing you can vote at the AGM, annual general meeting. That's all. That's the difference, right? So then ordinary shareholders. Now, how do you invest in share market? That's also important. Basically, you speak to one of the brokers, share brokers. There are 24, 28 brokers, and you can have it. But there is now you don't want to physically do it. Only thing you will have to. There is an app to be downloaded, CSE app. Then you can, once you go through this app by giving all this data, then you will have to select the broker unit. Then the broker will call you within a day or within 2 days time. Right? Then you can open this CDS account, right? So like when you open account in bank for your deposits, for your savings. Here you are opening account. We call it CDS account, right? CDS account. So everything will be recorded in the CDS. You buying, you're selling, everything will be recorded in CDS account. That is your account. So it's scriptless. Scriptless means there is no document to be exchanged. So only the scriptless, only the transactions are happening in the form of scriptless. So end of the 1 month period, you will be getting a statement from the CSE, Colombo Stock Exchange. So then you can see what are the transactions you have carried out or performed. And also remember that CSE and SEC, two different institutions, both are government institutions, in the sense the regulatory bodies. Now, share market is regulated by SEC, Security and Exchange Commission. So the treasury bonds are, that market is basically government security markets. It's regulated by Central Bank of Sri Lanka. This is one of your question, not in your exam, the other exam, financial market operation subject. And the regulator, they tested the regulator about the regulator, right? So basically remember that regulator for this share market is SEC. So what do you mean by CSE, Colombo Stock Exchange? Colombo Stock Exchange is the trading floor, right? Colombo Stock Exchange is below SEC. SEC is the apex body, the top body. Then below that you have SEC, where the trading flow is managed by them only. Right? Understand that, right? And the role of the SEC is not necessary. It is not under your syllabus, but financial market operation, yes, that is, you have to learn the role of the SEC and CSE as well. But here we are not discussing that part, right? So when you become an ordinary shareholder, what are the things you get? So we discussed when you become a shareholder, ordinary shareholder of this particular company, you are the absolute owner. So being an absolute owner, what do you get? Being an absolute owner, true owner, you become a true owner, what do you get? There are rights of the equity shareholder, right to income. So when you say income in relation to the share investment is what? Dividend. You have entitlement, you are entitled to have dividend. Now, right to control. What do you mean by control? Control means you become a shareholder. So if you have more than 51%, if you are holding particular company more than 50%, so you become a controlling party. Controlling party means what? You can appoint directors. So the entire company operation is under you. Entire operation is under you. Now, when you are discussing the mergers and acquisition, we will be learning there are two types, direct and indirect. So you go and buy this particular company shares, that is direct. Indirect means you have a subsidiary and subsidiary will invest in this particular company. Now, example, you want to have a controlling stake of John Keats, example. So what happens is you buy from the secondary market, you go and buy physically, you go and buy. That is direct. You only invest. But you have a subsidiary company also. We say XYZ. XYZ also investing in purchasing shares in John Keats. Now who controls XYZ? You only. That is your company. You as an individually invest John Keats. Your company, we call it a subsidiary. Your company is also investing in John Keats. So direct and indirect. So once you have direct, indirect, more than 50%, you are virtually holding this particular company. You are controlling particular company, right? So there are methods you'll be learning, and the examiner is frequently testing. Then how do you avoid this type of thing, right? Sometimes you may not be able to avoid, right? Acquisition. So the hostile acquisition we call it, friendly acquisition and hostile. Hostile acquisition, right? So then how do you avoid the pre-hostile? So then after you acquired, so how do you avoid it? That is also we'll be discussing under this mergers and acquisition. So here these are the rights. So you have a right to have a dividend, control. What do you mean by preemptive rights? So anything you offer to others, you should be offered. Anything offered to others, before that, you should be offered. Now, for example, if you are existing shareholder, then the company needs money. Company first should tell you why you are existing shareholder, rather than telling other new investors. Company should tell you first. Right, we'll be learning, but that is what right issue, right? So now see how the company, now say there is a company, how this company get finance. One thing is they can ask existing shareholders under what? Preemptive right. Or otherwise they can have many modes. What? They can issue new shares. So say I am outside of this particular company, I don't have investment. They can ask new investors to purchase. So then the money comes to the company. Or they can issue what? Now we know that they can issue debentures. Now in the examiner can test you which one is recommended by you. Is it issuing debentures, issuing shares? So we'll be discussing this type of question examiner test you. He is giving a statement, interest rate is this much and future interest rate this much. Then what do you recommend? So then you should think from the issuer side, not from the investor side. Only thing, don't go wrong. Only thing, read the question properly and think the examiner is asking from which side. Is it the issuer side? Now, when you are an issuer, you like to have low cost, but you have to pay. If I am the investor in your bank debenture, you only arrange it. But you are working in the investment banking division, you arrange it. You like to have lower cost, but you have to pay it. So I like, as an investor, like to have more return. So there is a mismatch, right? High risk, high return, like that, right? So you need to have lower return. lower cost in your expense. So only thing completely different when you think either investor side, either issuer side. So issuer needs to have lower cost. So basically, then you can decide if the interest rate in the future is going to go up. Now, generally, dividends are costlier than interest. Why? Now, dividend is what? Compensation for the shareholder income. When you invest in any particular company, you should be given dividends. That is the compensation for the investment. When you invest in debenture, you get what? Coupon interest. Only thing, two different, right? Same income, but the two different names, dividend and income. Dividend also many types. Now, if you are investor in any company, these days you are getting what? Dividend income. Sometimes you might get checks. Sometimes company will credit your account as well. That is also possible rather than sending checks, physically checks, right? So that is in money form. Sometimes if the company does not have money, now understand money and the profit are two different things, right? When a company is profitable, it doesn't mean that the company has money. Money, liquidity, and the profitability is two different things. Sometimes company has money, but they are incurring losses. Sometimes company are profitable, they don't have what? Cash. Many reasons. Profitable, but only thing they have done the sales on credit. They don't get money. That type of thing can be happen, right? So the only thing, profit and the money, profit and the, now we know, we don't say money now, we say power, profit and the liquidity. These words now is familiar to you. Profit and the liquidity are two different things. Now, if the company does not have money to pay this dividend, even they earn profit, they don't pay in cash. Then there is a term we call scrip dividend. That is one type of dividend, scrip dividend. Scrip dividend means dividends are paid in the form of shares. Rather than giving you cash, company shares are issued to you. Some investors don't like this. They need money. There should be some physically cash basis income. So the rather than now, so if say there is a company, only thing this month, this year they have made a profit, but you know that in next few years they are making losses, but they are giving shares. No point. You won't be able to sell it, and you don't like it. Sometimes shareholders are asking their dividend in the form of money. But if the company does not have money to pay dividend, they can issue dividend, they can issue shares. That is the mechanism we call scrip dividend. That is also possible. Right? Scrip dividend. The company doesn't have money, but they have announced the dividend. Dividend has to be paid. So then they don't have money. What they do is they are issuing their own company shares. Own company. If you are investing in the John Keel's company shares are issued to you. Right? So then what happens is you as an investor, your number of share holding or the number of shares you are holding is increased. Right? Number of shares. These are the rights, right? Liquidation now. Now, when the company is liquidated, what do you mean by liquidated? The company is going to close down, or somebody is going to be acquired. So then the merger means what? You get together. Acquisition means you are there, the other company is there, then you acquire. So both the companies are existing if it is an acquisition. But the merger means you get together, the existing companies vanishes. New company comes. So when you want to liquidate a company, the anything left, meaning after you paying everything, first you have to pay government dues. Once you sell your existing assets, you have to settle the liabilities, everything. Anything left, only you get it. Why? You are the true shareholder, real shareholder. So you get the last. You get the last. Remember that we discussed subordinate shareholder, subordinate debenture, and tier one debenture also. You get the last. You're more like you're subordinate to the shareholder. අයිතිකාරයට පස්සේ ඉන්න එක. අයිතිකාරයට ඉස්සෙල්ලා ඉන්න එක. So that anything left, you get first. The last one is the absolute total, like that, right? So then, under the liquidation, you have a right to receive, but the priority basis, you will be little last to get anything left. Sometimes you might not get once you pay off all these creditors, and if you are not having anything left, then you won't get it. And these are the advantages of equity capital. That is very important. So the examiner can test you why you are recommending to issue shares. So he can test you why you are recommending to issue ordinary shares, why you are recommending to issue debentures rather than equity. So what happens? Now when you issue new shares, what happens? Company gets money, that's true. What happens to your existing shareholding? It's dilute. Now say we have 5 shareholders at the moment, particular company. You are issuing shares to new. Another 5 comes, then how many shareholders now? 10. Would you like to have 5 shareholders, 5 owners or 10 owners? Obviously 5. Why? You have a bigger chunk of dividends. So when you have more people, your ability to control is diluted. So that is one thing why shareholders don't like issuing new shares is dilution of existing shareholders. So when you are discussing this right issues, we will be discussing how this dilution comes. Right? Obviously, now generally you think 5 shareholders, then another 5 comes. So then we have all with the 10. Same company. New shares are issued, that's true. But think from the people side, number of people side, 5 becomes 10. So everything, all the income is distributed among 10 people. You don't like it. Existing shareholders don't like it. If the existing shareholders don't like it, you have alternative method. What? Right issue. Right issue is for who? Existing shareholders. Right issue is who? Existing shareholders. Existing shareholders at the discounted price. Remember that. Existing shareholders at the discounted price. Why do you want to have a right issue? You don't like others to come into the company. You are asking existing shareholders, but under what? Preemptive right. The existing shareholders don't like, for the right issue, don't like, then you go to the others. Right? That's all. Right? Now these things you can read it, right? And I'll be coming to this right issue as well. And when you issue shares, as I told you, there are many methods. So basic method is we can have this IPO, public offer. Now see, there are few methods for you to issue shares. Placing. Placing means what? Private placement. Opposite of the public offer. Public offer means what? IPO, initial public offer. You are asking, you are inviting everybody to participate. You are asking, basically, you are giving invitation to everybody. Now, remember that we discussed when you're issuing a IPO, there is a document to be published, that is prospect. Prospect has to be published. I told you, I showed it to you. The HNB recently issued debenture prospect. Similarly, public issue also similar. You should give all this information. Recently, what's the recently issued IPO and now it's trading? What's the company? Jet Holding. It's being traded now in the CSE. They had IPO. There is another IPO is coming. Hella Clothing. Hella Clothing. That's IPO fund. So then once you finish IPO, then it will be generally it will be listed in the share market, right? So that's what actually happens. So the costly, the print prospectus, you have to publish everything, put advertisements and all those things is very costly. Private placement is what? Placing. Individually, you contact investors and asking, so we are issuing shares of this of our company. Would you like to invest? You physically go and ask. Not physically, but what you call the personally go and ask. You personally encourage them to invest. Personally speak. Individually you speak. You individually you find out the people. You go and speak. So everybody doesn't know. Public doesn't know. But you are approaching to individuals. If you can find out 10 people, that's fine. You have amount to be issued, and you speak to the big customers, then they will participate. Nobody knows. Private placement. Stock exchange listing. Now remember, by listing, you don't get cash. What do you mean by that? Now, John Kill, for example, I'll take this particular company. John Kill's company is a listed company. It's trading at CSE. Now, you are buying shares today. Tomorrow, you are buying 1,000 shares. John Kill. Does the John Kill get money? No. The particular company does not get money now. When they get money, when they issue shares at IPO, right? So the secondary market, when you're buying, when you're purchasing secondary market, the company does not get anything. Now, for example, now Jet Holding recently IPO is one. Right? When you issuing IPO, when you invest in IPO, you invest, your money goes out, company Jet Holding got money. Now they listed. Now you are one of the shareholders. Now you are seeing the pricing. Now I need to buy it. I have not invested in this IPO. I think Jet Holding shares are good, then I need to buy. So what happens is I put an order, buying order. Then I am getting it. So my money goes out. Who gets the money? Some seller. Seller means the one guy who has invested in IPO. Does the company pay? No. Company has isolated now. Company gets money. Company got money. Now they are doing their business. Here the sellers and buyers are doing it. Understood? The company does not get anything. Only thing the seller and buyer, you and me. You are the seller, I am the buyer. Does the company involvement happen? No, nothing. But can the company be isolated? Can the company close their eyes on their pricing of this particular company? Sure, no. Why? The value of this particular company is determined by the share price. Very important. When a company's share market price Coming down means company is basically deteriorating. Company likes to have the market value more. Company likes to know people who are buying more, people showing more interest in their shares. So the market capitalization we learn. So the company, as a company, you like your company valuation to go up. So now say for example now John Kill's company is going to be acquired by me. So what is the value? How much do I have to pay you? There is a valuation mechanism also we will be discussing, but general screening how much, then I will see how much, what is the price going at share market, or I'll take the average, last 3 years average, then I multiply into number of shares. This is your valuation. This much only you worth. So very important for you to value your company share market price, right? So the market price is very important for the company to have valuation. When you sell it, very important, right? So the right issue for the existing shareholders, we are issuing shares. Does the company get money? Yes, they get money. From whom? Existing shareholders. Why you are issuing right issues? You don't like your existing shareholders' control to be diluted. Existing shareholders don't like to have new shareholders. We will give you first under what they are issuing? Preemptive right. Is it a right for the ordinary shareholders? Yes. There are many rights: right to income, right to liquidation, right to control, the preemptive rights, right to receive annual reports. So when you are investor of this particular company, any company, listed company, even you are holding one share, you are getting what? Annual report. Now it's a CD form now, right? And also you will be convening to the annual general meeting for you to vote. Even you are holding one share, if it is voting shares. Right? That's a right of you, being an ordinary shareholder. Right? Share options means what? Now you know options means here the options is basically ESOP, employee share options. Sometimes companies also now when the company is going to be private, then generally we get this SOEs, state-owned enterprises, right? When recently, not recently, but long time ago, uh, the Sri Lankan airline did it. So when they want to privatize it, and they issue shares to the existing employees, existing employees. So the employees also become a shareholder of this particular institution like that, right? So then those are the methods. Understand and remember this. These are the methods of issue share, right? Now all these things we have discussed now. Now only thing I had to give you this stock listing D07, and I'll be uploading everything today. You will be seeing that, right? And it explains everything. What do you mean by placing? Placing means what? Private placement, right? And also understand and also remember this. Methods of listing. Methods of obtaining a listing. An offer for sale. Remember, offer for sales are there only for the shares in issue. Issue corrupt shares already. Vitarai offer for sale in. Prospect issue means what? New shares, not previously issued. Now tell me if it now with regard, I just want to ask this question since we have done this. If it is a new with regard to the government securities, economic can test it. If it is a new government security issuing, or forget about your debenture is issuing, your bank is issuing a debenture, new share, new issue. What is the nominal price? In Sri Lanka, it's 100, right? If it is new issue with regard to debenture or corporate bond, now debenture issued by whom? Government or no? Government is not issuing debentures. Right? They are issuing treasury bills and treasury bonds in rupee terms, dollar terms now, SLB. Who issues corporate debenture? Government? Central bank? No. Corporate debenture issued by corporates, companies. Now, debentures and corporate bonds. If it is a new issue, what is the price? Per unit price you are issuing? It's 100. Why? Not previously issued. Not previously issued. So then issued, you have purchased, after 3 months time you need to sell. Then what happens? Do you like to sell particular, so you are investing in one unit, 100 only you have invested. Now you are holding, your investment is 100. After 3 months time you want to sell this. Are you selling at 100? No. You are selling at more than 100. So you are selling at a premium. If you want to sell it, whatever the if you want to realize your money, you are selling at, you are decided to sell at 90. You are selling at discount. So there is a portion involved. What? Accrued interest. Clean price, dirty price. So I'll be taking that part separately with you. Only thing under the government security, that is the only part we'll have discussed. I'll come back to later when we're dealing, right? Calculations. I'll come back. It's only part. So basically, remember that if it is new issue, it can be 100 price, nominal price. If you want to purchase from the secondary market, then it has to be either premium, either discount. If you like, you can sell at 100 as well. That is your choice. But it doesn't mean that you are selling at a nominal price, right? 100 only you are. So generally you are selling at a more than 100, whatever the price you have purchased. Then only you can earn a profit. Which profit is this? Capital gain. Right here, discussed, right? So methods of listing also understand, and there are two boards to be listed. It has to be listed on two boards. One thing is main board, the other one is the reserve board. And also we discussed, remember, all share price index and S&P. Those are the two index available in Sri Lanka. And in USA also remember that there is a index called Dow Jones. Dow Jones, right? That is their market. And in India we have Sensex. Right? In Japan share market we call it Nikkei. Right? Sensex, right? Now, last few weeks, even under this corona impact, share market has gone up. Right? Share market has gone up, and similarly, other around the world also share markets have slightly gone up. So they are performing well. Other share markets in the world as well. Now, this RVP, DVP, basically a new method coming to share market for the settlement purpose, and they are going to issue this. They are going to introduce this next week. So I'll give a note on that. The examiner can test you what is this DVP method, right? So when you sell shares, what happens is your shares go, now. So you are holding shares. Now you want to sell. You are selling. Your shares goes out. Whatever the entitlement you had, your share goes out. Your shares go out. Does your money receive today? You don't get money today. You get T plus 2. You have nothing, but money also you don't get it today. Settlement date only you will be receiving money, but nothing. Shares are no more with you. To avoid this, SEC has introduced this DVP method. Delivery versus payment. Payment එක හම්බ වෙන්නේ deliver කරන දවසට. Deliver වෙන්නේ payment එක කරන දවසට. අද කල් ඉවරලා අනිද්දාට නම් මේ සල්ලි හම්බ වෙන්නේ. So අනිද්දාට තමයි your stock also goes out on the same day of the payment, PVP. So they are going to introduce it. And also another thing is there is a new act to be passed, SEC Act. That is also possible to discuss in the Parliament next week. So we will see that what are the changes to this, but it's going to be investor friendly thing, and we will see that also we will discuss. I'll give you some notes on that once this act is passed, right? So what other things we can take it from that, and yeah. Now what you can do is, shall we go whatever the notes we have given to you one by one, then we can see them. This part I have done with you. Treasury bill, treasury bonds, these are the things. Preference shares also we discussed. Preference shares are different from ordinary shares, more like borrowings. They get coupon interest as well. They are not treated as true shareholders, right? Initial public offering we discussed. Debentures we discussed. LIBOR rates we discussed. The only thing, LIBOR rate is going to be scrapped 2022. So then we have alternative methods, SONIA, SOFA, and all those, right? Then we have discussed this part. Sometimes you can read these things. Now see, these are only things for you to read. Sources of finance also you can. And this market capitalization we discussed, the market value plus. Scrip dividend also available here. Now what do you mean by retained earnings? Retained earnings means accumulated profit, right? We'll be discussing in detail in mergers and acquisition. I'm sorry, not the merger and acquisition. When we're discussing the capital restructure. So the capital restructure is basically a loss company. Loss means you don't have profits. So retained earnings are not there. And also remember, preference shares also described here, the differences and what do you mean by this, and also types of preference shares, and also we discussed types of ordinary shares as well, right? These are the types of debt capital. So then you have a participating shares also. This one. Cumulative and non-cumulative, only thing you can read it. Cumulative means anything if you don't pay this year as coupon interest, you can accumulate and pay later. Accumulate and you pay later. So why don't you pay? You don't have money. Simple. Can you say preference shareholders, I don't have money, I'm not paying? If it is cumulative, then you can. Otherwise you can't. Right? Redeemable, irredeemable. So after 5 years time, you will be receiving your cash back. Which one? Face value. Remember that we discussed participating and non-participating. Now participating preference shares means anything. Now generally profit belongs to whom? Profits belongs to whom? ordinary shareholders. Now, when you calculate the profit, you deduct preference shares coupon interest. You arrive to the profit after deducting preference shares coupon interest. So the final profit belongs to whom? Ordinary shareholders only. But there is a type of preference shares. Ordinary shareholders profit, portion of the ordinary shareholders profit also belongs to this type of preference share. That's a embedded options, right? So it's options only. These things are not available at the moment these days, right? Very rare. Only the theory part. But can it be? Yes, can. Disadvantages, advantages also. Advantages and disadvantages compared to ordinary shares. Ordinary share now say dividends are not compulsory to pay. Now say company is making profit, company is making losses. AGM we don't have profit, we are incurring loss, so we are not in a position to pay dividend. If the shareholders agree, then you don't get, you as shareholders, you get nothing as dividend. Why? The company has made loss. But can you say preference shareholders, we don't have anything, so we are not paying? You can't say that. You have to pay anyway. Pay anyway. So which one the cost is more? Dividend cost is more. Why? You don't know. Now there was a question, equity capital and debt capital. Now you know these terms. Equity capital. Equity capital means what? Owner's money. Debt capital means what? Issuing debentures, borrowing from the banks and all those things. That is debt capital. Which one is costlier? Dividend equity capital is costly. Why? You don't know how much you will have to pay. You don't know how much you will have to pay. Now, if it is debt capital, if it is a debenture, you know if it is 10%, entire period 10% has to be paid. That's true. That's it's constant, fixed, no change. But is it similar to the debenture as well? Dividend as well? No. Dividend can be changed year on year, depending on the profit. If you are making significant profit this year, you can pay dividend more than the previous year. It can be. Dividend may change year on year, but debenture interest will not be changed. Even you are issuing a debenture under variable, margin won't change. Only thing this treasury bill, whatever the reference rate will be changed. But generally, we say government securities are less costly than equity capital, right? Fixed and floating, we discussed this. If it is floating, what is the reference rate? It depends. 6-month treasury bill වෙන්න පුළුවන් AWPL. It depends. Right? Very we have seen AWPL are also taking this as a reference rate, but very unlikely. Right? AWPL are lending rate. But how can you say that? It depends. We have seen HDFC once they have taken this AWPL, right? In issuing debenture. And these are things you can read it. Bonds also we discussed. And deep discounting bond, let's say types of bonds also, right? Tell me an example for the deep discounting bond. Example is what? Treasury bond. I'm sorry, treasury bills. Treasury bills are issued at discount. Treasury bills are called at zero coupon. Examiner can test it. There are debentures. So generally we discuss debentures are issued at par 100. Now here what? They are issuing debentures at 80 rupees. But after 5 years time, you will be receiving 100. Same type of instrument we discussed. What? Treasury bill. Treasury bills are issued at a discount. Treasury bills are issued at zero coupon. So the same scenario also comes here to private companies' bonds. Same mechanism. Same mechanism. Discount, deep discount means hungak palayan, not 100, 80, example, 85. But on the maturity, you are getting 100. We have discussed a similar instrument, which is treasury bill. And also we discussed this as well, right? Convertible debenture. Convertible to what? Shares. Convertible to who has the right? Investor has the right. Holder has the right. Investor has the right. Where did we get this convertible bonds option? Under what we discussed? Remember that we have discussed Basel III compliant debenture. Those days we issued subordinate debenture. Now we are not issuing subordinate. We are issuing, but we are. If you want to take this particular instrument to the capital, you have to issue what? Convertible debentures. Basel III compliant debentures. Take into the capital. You can take into the capital. If you want to take into the capital, it has to be convertible debenture, right? Callable debenture also. Who has the right to call? Who has the right to call? Issuer has the right. We discussed this one. Yes, we discussed. When the interest rate you issue a debenture, you think that the interest rate in the future will go up or come down. When you want to put this callable option in your debenture, you are working in the investment banking division, you are issuing a debenture for your bank or outside a company, then you suggest to have this callable option. Why do you suggest it? Callable option, why do you suggest to have this callable option in your debenture issue? When what happens is when the interest rate comes down in the future, today you issue at 10%, but after 1 year's time, interest rate has come down to 2%, example, but still you have to pay 10%. But we have discussed this, right? So then if we have included callable option, then you can retire this and you can issue new debentures. Then you will be paying at 2% rather than you paying at 10%. Who will be in trouble? Investor is in trouble. So they think that okay, I'll be getting 10% gani hamena avdu pahak kela he is happy. But suddenly you exercise this, then you won't get it. Putable option is another one, right? Junk bond means when you issuing now high interest rates bonds are, we call it junk bonds. Now Sri Lanka ISB, Sri Lankan ISBs. ISBs means international sovereign bonds are trading at double digits now. Now we have been downgraded by 3 rating agencies. Even we paid the last July 27 bond, ISB bonds. Still our bonds are trading at double digits. So meaning that dollar bonds are trading at 13 to 15% now, right? So basically, it's basically now coupon interest rate. Now those bonds coupon interest rate maximum is I think it's 6% or 7%. Now see 7% you issue coupon interest. Now the market is at 13%. 7% you issued at 7%. That is coupon. The new issue, ISP. Now the market is trading at 15% example. What happened? What we are talking about now? Issued at 7%, which is coupon interest. Now it's trading at 15%. Price has, not the price, sorry, yield has gone up. When the yield has gone up, what will happen to the price? Should come down. Price should come down. When you are issuing, when the Sri Lanka issuing the ISB at 7%, price is, we say 7% of the calculator price is new issue now is 100, right? New issue 100. Example. Now the market is going at 15%. Yield has gone up. Price should come down or price should go up. Yield has gone up. Price should come down below 100. Now it's trading at, for example, we say 70. 100 it's going at 70. 100 I have invested. Now the market is, somebody is there to buy at 70. Why this has happened? Investors, foreigners who have invested at the IPO, initial public offering. Initial public offering in the sense the first issuance. So the ISPs cannot be invested in Sri Lanka. They can't. Sri Lankans cannot be invested in, right? Only the foreigners can be invested in international sovereign bond issued by the government of Sri Lanka, right? So then I was holding this 7%, 100. Now it's going at 7. Now what happens is, why this has happened is, I like to realize my money even at a significant loss. At least I am getting 70. If I hold in it till it gets matured, sometimes government may default it. So that's the perception foreign investors have. So even if I sell it now, I am getting at least 70 rather than waiting it get matured. So sometimes the government says, no, we don't have money to pay, then I will be losing everything. If I sell it now, I will be at least getting 70. So that's the perception they have. That's why the market is reacting. So basically, not that the buyers are there to buy, but the sellers are willing to sell. Investors are willing to sell at a lower price for them to realize it immediately. And that's what actually happens. But who will be benefited? Buyer will be benefited. Why? If you purchase in this particular 170 on the maturity, if you have confidence that Sri Lanka, then you purchase this. Today you purchase at 70, end of the period, on the maturity you will be getting 100. You're better off, investor. So we know that Sri Lankan government has never defaulted anything, and recently also they have honored their payment. In the future also the same. So anybody who is having trust, so they can purchase this particular bond. Now in Sri Lanka, banks were allowed to invest, but the central bank has discouraged of investing in ISPs. Why? Our money goes out of Sri Lanka. But they have liberalized it, they have released it. Earlier it was banned. Now banks in Sri Lanka are allowed to invest in ISPs, provided they bring fresh money. They borrow and they invest. To borrow and invest, that can be possible, but not everything, not the whole thing, but the 50%. 50% you should invest in SLDBs, 50% you should invest in ISPs. So that's the condition central bank has put. That's the condition central bank has put. So that is also there. Earlier it was banned, now they have liberalized it. So that condition has been enforced, right? So basically our bonds are under Jangan bonds, right? Trust is there to whom we discuss also that as well. Protect the investor interest. Conversion, this is convertible debenture, they are discussing it. There is a question on this, we'll be taking this question, doing the question. Securitization, you have separate topics. Syndication is also, you have a separate topic. This period we have discussed, these questions also we have discussed. Treasury discounting, basically treasury discounting means now if you want to sell this particular instrument, you go to the primary dealer where you purchase from, then you discount, right? And this negative relationship also we discussed. Treasury bond, that's question, two questions we discussed. This one has to be discussed. I'll be taking this tomorrow, day after with you. Intrinsic value discussed, this one discussed, like another also discussed, right? This part today we discussed, facing. Right. I told you the offer for sale already shares in issue, already in issue shares, right? Already in issue, already in issue. Remember that when share around SLT is a listed company, when SLT issue shares, already issued shares only they have listed. So this is offer for sale. Fixed price, tender price. So this is only once. This IOC only did this. Samanyan when you issue shares, you have fixed share, fixed price. Like debenture, you have fixed. But once IOC came into Sri Lankan market, they did IPO. They had a tender of tender system as well, like you do for this primary dealers, like primary dealers do this treasury bond auctions. Tender, you put your bids. This is your price. They have given three price categories, and your prices like that. So very difficult, cumbersome task when you have this, right? Now introduction is what? Methods of listing. Introduction means prospect issue we know, public issue, offer for sale or shares in issue, place in private placement. Introduction is what? Introduction means basically you want to list, but you don't need money. Why do you want to list? Once you get listed, you get number of benefits. What are the benefits you have? So your company is listed. So people like to invest in listed companies. Why? Now see there is a company called ABC company, which is unlisted. But there is a listed company in the stock exchange. We say Colombo Dockyard. So you have money. You are asked to select one of these two, Dockyard or ABC company. Dockyard is listed, ABC company is not listed. Which one you select? Obviously you go for Dockyard. Why? You can have everything. You can see everything. You get to know everything. But ABC company, sometimes they are not giving you accounts. You don't know what happens inside. You don't know. But Dockyard, they'll have to publish everything. They'll have to tell all this information to the public. Why they are listed? They are more transparent. Corporate governance are there. So they are governed by the rules and regulations. Very much transparent. So the people like to invest their money in listed company rather than unlisted company. So the lot of benefits. I'll be giving a note on this as well. This is there was a question not in your exam, but the financial market operation paper and the benefits of being listed. Right? You get you can access to number of people, number of shareholders. Then transparent corporate governance is there. All the disclosure has to be made very much transparent, right? So rules and regulations are there. Now before you being listed, you have to comply. After you being listed, also you have to comply. So the before and after compliance has to be there when you are a listed company, right? Introduction means what? You just want to be listed. You don't want to issue IPO, you don't want to issue for sale, prospectus issue, nothing, just being listed. There are companies like that. Right? This question is I'll be not taking with you all since this is very old one. This is the question. This is the method IOC has introduced. Right? They have given several pricing and several number of shares to be applied. Like that, right? It won't happen now. And these are things advisor can read this. Now underwriting. That's what I need to discuss. Underwriting means what? Anything unsubscribed. Now say when you are issuing shares, when you are issuing debentures, if you are not sure about it, whether people will subscribe fully, I told you normally banks are issuing debentures. So following day they are putting advertisement that oversubscribed. Remember that I showed it to the SMB oversubscribed. So if the people are not investing in this particular company, then you are not sure of investing whether the people will invest. Then you appoint an underwriter. Underwriter is what? The person who buys, or the company or the institution who buys unsubscribed shares. Unsubscribed. Right? Underwriter has to be unsubscribed shares. Right? Now these are the listing costs, the huge cost involved in being listed. Right? Listing, the advantages of being listed. Public listing. This is a right issue. Right issue I'll be not taking now since there are calculation part also involving. I'll be taking later. This is right issue. Right issue is for whom? Existing shareholders at a discount. Now see, read this. Read this question, please. This one. Now market price is 1st July 210 per share. Company decided to make right issue at one new share at 150. Some generally when you issue share, when you issue shares under rights, when you have a right issue, it goes like this: 1 for 4 shares. Example, right? The figures may be changed, but the pattern is same. 1 for 4 shares at 15. What do you mean by 1? 1 means new. If you are existing shareholder, true. If you are holding 4 shares, you get 1 new. That's the meaning. If you are holding 4 shares, you get 1 new. So then if you are holding 200 shares, how much you get? 50 shares, like that. 1 for 4. එකක් දෙනවා 4කට. At 15. 15 is a discounted price. Market may be going at more than 15. Market is anyway going at more than 15. Market is going at 18. But since you are existing shareholders, you are getting at 15. I'm getting it, right? Market price is July 210. Company decides to make a right issue at one new share 150. Right issue price is 150. Who decide this 150? Investment bank people decide. Every 4 shares already held. If you are holding 4 shares, you are get one new. එක share how much? 150. After announcement, share price fell to 195. So generally, why the share price is coming down? After right issue, you have more number of what? Shares. හතරක් තිබ්බ එකට එකක් දෙනවා. ඒතකොට number of shares increasing in the market, so the price should come down. So we call it the price. It's theoretical extract price. Theoretical extract price is the price after issue, right issue. So we will be taking that part with this tomorrow day after, right? So the examiner can test you this kind of question. I'm just giving you. Tested several times. Company current market price is 210, and the company wishes to make 145 rights issue at a discounted price. Discounted price means present market price is more than 180, right? The examiner can test only the examiner has tested this part, right? Not this part. So value of a right not tested, but the theoretical extract price has tested, right? And so that part I'll be taking tomorrow or day after, how this pricing calculation happens, right? And when you're issuing rights, when you issue right issue, you have different types of options. Right issue is for who? Existing shareholders. Existing shareholders. Now say there is a company called there is a listed company called ABC company. They are going to issue rights. Why they want to issue rights? They need money. Why do they need money? They will have to undertake some projects. Company. So they decided to issue rights. Why? Existing shareholders can only be participated. Company is making losses all these previous years. Now they have decided to issue shares, right issue. You are one of the shareholders. You have entitlement. Do you invest? Company has never paid recent past dividend. Continuous losses. Do you pay? Sorry, do you invest? There are 4 options available for you. One thing is either you exercise, either you completely ignore, renounce, or either part or do nothing. Now, normally, once you get the when you have investments in share market, generally you do the last one, do nothing. You do nothing. You don't invest, plus you don't sell. But remember, if you don't do mean, company will sell this particular shares to somebody else. So you decide and you pay, you sell it. You tell your broker, I have rights this much. Whatever the price you sell, I am not interested to invest. You sell these rights. Can the rights sell? Yes, rights can be sold. Rights are being trading in the share market. Rights can be sold. If you are not interested to purchase, then you are selling it. Somebody will there who is interested in buying, they will purchase. So that's all. But company needs money anyway. If you don't invest, being an equity shareholder, company will sell it to somebody else. Once you put in the share market means anybody can invest. It doesn't need to be existing shareholders. Now rights are being traded. Whose rights then are being traded in the share market? People who don't like to invest. Mama rights the capital some company, I can sell it. How do you sell it? Share market rights trade වෙනවා. John Kills වල rights මොනවාද දුන්නාම if you don't have money to subscribe, then you can sell it. Whatever the price available, you can sell it. At least you get something rather than doing nothing. The rights are being traded. John Kills rights are being traded with John Kills. Right. So you can take it, you can subscribe it, you can partly subscribe, you can avoid it. Everything you can be done. These are the four. And also repercussions also this. If you take it, you're maintaining a shareholding percentage. If you don't purchase, you're losing your percentage of holding. When you're doing a question, then you will understand how this dilution comes. The only thing, just for the time being, you remember there are four options to be entertained if it is a rights. If it is a rights. And another option is, similar option is bonus issue. What do you mean by bonus issue? Bonus issue also very much similar to this, but only thing there is no cash movement. Bonus issue, there is no cash movement. Bonus issue means basically you convert your existing reserves to shares. That's all. No cash. But on right issue, yes, cash comes to the company. This is scrip dividend, right? Bonus issue, this one bonus issue. Share split means what? 10 rupees share එක then we have more number of shares. Why do you do this? Now you know there are companies in the share market which are not liquid. What do you mean by liquid? There are no shares to be purchased. They have issued only few shares to the market and the people have already invested, then you like to purchase it but no shares. Nobody is willing to sell. Illiquid shares. For you to have more liquid, රුපියල් 10 share එක රුපියල කරනවා. So then we have more number of shares. Only thing you will not change the issued capital. Entire issued capital will not change, but only the share price, her share price is changed. Then you have more number of shares. These are for you to read, right? So only thing that I told you, these are the investor ratio. Remember the last week I told you EPS, gearing, ROC and all those things. I'll be giving separate note on this, right? Price earning ratio. And this one also I have discussed with you. Remember the systematic risk and unsystematic risk. This has been also uploaded. Systematic risk you can't avoid. It's common to everybody. Unsystematic risk you can avoid it by diversification. And the CAPM also I'll be taking when we are doing this particular one. I just want to do one thing with you. This one. Now these are the yield curves we discussed. Remember when we are doing government security and issue management. There are four types of yield curve. One thing is rising, increasing. The other one is declining. The other one is flat. The other one is hump down, humped. So these are the four. Now, what do you mean by? So what is the importance of having yield curve? Now all those things we have discussed, right? Yield curve, you know, you are familiar with what yield curve is. So yield curve is basically gives you a direction of future interest rate. When you issue debenture, you are working in the investment banking division. When you issue debenture, you take the pricing based on the yield curve only. Based on the yield curve only, you take this decision. So yield curve is very much important. So there are four types of yield curve, but only thing examiner once tested that what are the three types of yield curve. So then Humpet is not there. But I don't know why the exam has tested like that. But generally there are four types. Right? Only four. There are four types. These things you teach that. And there are four types actually. Humpet is also one of the shareholders. Now this is now see this one. Now 3 months. This is how you draw your yield curve. You take 361 treasury bill. You don't have 2-year treasury bill. Then you take what? Treasury bond. Market yield. And you have graph putting all these things, that's all. Now tell me, if you take this 3 months 630, meaning is what? 3 months meaning is what? After adjusting inflation or not? Discussed. Yes. Treasury bill rate means now treasury bill has gone up to 5.32 from 5.28 last week, right? So the 1-year treasury bill rate is going up. So when the treasury bill rate going up, which is risk-free rate is going up, meaning in the future there is a tendency interest rate to go up. Now treasury bill rate comprises of what? Inflation plus nominal real interest rate. So the interest rate, risk-free rate, basically risk-free rate is what? Generally we take it risk-free rate is treasury bill rate. Real risk-free rate plus expected inflation is the treasury bill rate. So basically what I want to tell you is treasury bill rate is after adjusting the inflation. Now treasury bond rate is what? Treasury bill rate plus maturity risk premium. This is the composition. Why do you want to add a maturity risk premium for the treasury bonds? This is how the treasury bond market yield comprises. Market yield has minimum component. If you say now 5-year treasury bond is trading at we say 7.5. How this 7.5 is consist of these three: real interest rate, inflation, and maturity risk. That's all. The 750 inclusive 750 consists of real risk rate, inflation, market risk rate. So what do you mean by maturity risk? Now say when you make an investment in 1 year and when you make an investment in 5 years, which one you think is riskier? 5-year one is going to be riskier. Why? We can't think of. But we can just predict after 1 year there will be some kind of relief after 1 year. 1 year that there can be defaults, there can be bankruptcy. But compared to 5 years, we can just say 1 year is secure. 1 year is secure. We don't know what happens after. We don't know what will happen after 5 years. We don't know what will happen 5 years time. But only thing we can have idea at least 1 year's time we can predict it. So basically, when you have investment longer horizon, risk premium has to be added. This is for the whom? What? Treasury bond. Now say treasury bond yield also inclusive of what? Maturity risk premium. So then you said you all can ask, you said that it's risk-free rate. Yes, risk-free. Which risk is free? Default risk is free. Counterpart risk is free. That's true. Government is paying anyway. But other risks are there. reinvestment risk, inflation risk, liquidity risk, everything has to be there. So for this, do some compensation. True that we call it a risk premium, but it doesn't mean that the counterparty risk premium, right? It doesn't mean that the default risk premium. No, other risks only we are taking. This premium is taking for the other risks only, not for the counterparty. Counterparty risk is anywhere not there in terms of government securities. Counterparty risk is not there in terms of treasury bonds, treasury bills. No, no counterparty risk. But other risks are there which we have learned already. For this, need a compensation. This is the percentage. Like that? Okay, understood. Then This is, this is an application of question, right? These are the risks we have discussed so far, and the other day also we have discussed. These are the risks, right? Available. Just floating and right. You can read it. Zero coupon example is treasury bill, and there was a question. This is the conversion callable option rate, and we'll be taking later when there is an examination question as well. I'll be taking that question with you all. Then this is sample given to you. And the valuation of bonds also this is important. So I'll be taking this part tomorrow or day after. Then I'll be covering this clean price, dirty price, and all those things, and be ready with this advertisement which I gave it to you on treasury bonds. I'll be taking that as well. Then right issue pricing, and also this valuation of bonds. So that I'll be taking. I'll let you know. It has to be tomorrow, tomorrow day after, most probably in the evening, like 6:30 or 7, right? I'll be taking this example. If you want to pass it with the live and pass it to page, otherwise you can watch later the video, right? Any question you have before we wind up? So I'll be taking similar extra classes with you on ad hoc basis, right? But anyway, I'll let you know. Has to be it has to be in the evening. Anyway, it will be in the evening, right? For your convenience as well, right? So we can fill it, right? Any question before we wind up? Okay, then we will meet up tomorrow or day after, and be ready with the past paper questions as well from the latest to previous, right? So be ready with the past paper. So we'll be taking these questions as well. Then we will be moving to next. Our topic is project appraisal. Right? I have been uploaded this. This is also we can finish it off. Very much similar to treasury bond calculation. So we can easily finish this. Right? Same thing. So, CAPM and everything we have to be discussed. We'll be discussing CAPM as well. So I will skip that one. That's why. So there is a formula also has to be learned. It is not given in your exam. So to keep in mind, and you need the percent value calculation also included here. So we can take it. We can take that. Right? Any questions? If you have no question,